9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Let's get to your top stories today. Stocks across the Asia Pacific, particularly tech, leading these declines, tracking a sell-off in U.S. chip makers. Nvidia now on its longest losing streak in 4 years as traders await its quarterly earnings.
US Treasury Secretary Scott Bessent threatens sanctions on countries that do business with Iran, potentially adding to tensions with China, Tehran's closest trading partner.
Washington also planning to impose additional tariffs on Chinese goods, testing a trade truce between both sides, and that's ahead of President Trump's next meeting with President Xi Jinping.
And we'll be speaking exclusively with the head of Wall Street's best-rated Chinese EV maker, Leapmotor, as first-half profit soars more than 500%. All right, take a look when it comes to markets here. You're seeing when it comes to the chips, they are falling here this morning. I think Nvidia down for 7 straight sessions is sort of adding to that sentiment, being dampened ahead of those earnings as well. And then you kind of add a little bit more of that geopolitical risk premium onto these markets now too, Dave.
Yeah, so you have Iran, you have Canada this week, and of course now the new one is China, which we'll get into in a moment, of course, with Minman. But yes, the Nvidia story is interesting because for the longest time, we were trying to figure out what the moat was and whether or not it was starting to look like some holes were being poked in that hole. And I think the margin story is going to be interesting when it comes out on Thursday. Yeah. But yes, I think we're down, I think the longest losing streak in years now for Nvidia. The chip story is interesting. And as far as you can see on your screens, the Nikkei is actually down. Kospi is down 2.5%. And it's really playing out across some of the big names that are up and running right now. So you have TSMC just coming online in Taiwan. It's very clear what's happening in South Korea there, and of course with the Advantest story, that's also of course the IT story and the chip drop that we've seen overnight. That takes us into a part of the market that has recently caught some tailwinds in a bid, maybe down more to the softer dollar, the debasement trade, and gold is up successive days now, as with silver, as with Bitcoin, at about 80,000. A reminder of what happened overnight, so a big drop on the EV space in China, Xpeng, NIO. Baidu also still saw some downside momentum, somewhat halted with Alibaba, which we'll talk about obviously on day 2, and we'll see what that looks like at the open today. A50 futures, and you have I think we're back below 1.7% on the Chinese 10-year yield, dollar China, on your screens at 672.
Yeah, let's get to our top story here this morning. Right now, U.S. Treasury Secretary Scott Bessent has threatened economic punishment against any country doing business with Iran as part of what he calls an economic D-Day campaign to end nearly 6 months of war.
I want to emphasize that we are spreading out across the world as we speak, that you will see a wave of sanctions when you leave this meeting today. And you should expect that cadence to continue. And I would expect that you will see a major announcement of a financial institution being sanctioned by the end of this week.
Let's bring in our senior editor, Derek Wallbank, now with the latest. Derek, certainly it was a slew of sanctions that were laid out here overnight. And walk us through just what are we getting now in terms of how far D.C. is going to go with this sort of economic isolation of Iran now?
Well, I think how far it's going to go is a great way to frame this, Yvonne, because this is really sort of the opening salvo. You know, Bessent had said that he was going to lay out this pathway for the U.S., but it really is a bit more of a pathway rather than sort of everything all at once. He did say that a major financial institution we could expect would be sanctioned by the end of the week, but we don't yet have that name, so we're not quite sure who he's talking about here. And he said a number of times through this that he's, the U.S. is preferring to deal with countries one-on-one rather than try and sort of put everything out on blast immediately. That raises a number of questions, not least of them probably number one is China, which is Iran's number one buyer of oil. And so that winds up being a big question, is what is the U.S. prepared to do vis-a-vis China? Are they prepared to go to sanction, the main core of the Chinese economy, if they're trying to get into the idea of this sort of revenue? Or where are these going to go? How deep does that go through? How much much do you go into financial institutions that may or may not be involved in any of this stuff? And how much do you go into insurance on ships? Do you send the Pacific Fleet off the, into international waters in the South China Sea to break up ship-to-ship transactions? There's any number of things that the U.S. could theoretically do, but a lot of those, I think, right now are left in the imagination. And key in all of this is that the U.S. and China have had a trade truce, right, for the last couple of months now. And there is supposed to be a Xi-Trump meeting in the United States in September. And while we have seen little escalations walking into prior meetings, you don't really usually see something that would up-tip the whole cart walking in there.
So walk us through the China angle, right? Because it seems like, if you read between the lines, Bessent seemed to be in some way sending a message to Beijing about its relationship with Iran. How does this all fit timely, right, in terms of timing? Because we do have that Trump-Xi meeting happening next month.
Yeah, I think right now the message from the United States is very clear that it wants Beijing to do a number of things. But the question I think that's still left in the mind is, will it try and compel Beijing to do things, and will it be able to do so? I think that's a very open question. There are a lot of people who are a little bit skeptical that that's going to happen, or that the United States may have the appetite to go as far as necessary to try and compel China to do, various and sundry things. So that there's a ton of gray area there. I wish I could say this is exactly how it's going to go over the next month, but I don't think that anybody outside of the White House and the Treasury has exactly those answers. And then, there's a very famous saying in boxing that says everyone has a plan until they get punched in the face. And pretty simply, what happens if the U.S. decides to go down a compelling route and then China retaliates in some form? We've already seen China have effective retaliation when it comes to things like rare earths. And as I say, there's right now, you can see in the U.S. response here, they do want China to take a different path, but we haven't necessarily seen that whole big consequence stick come yet.
Derek, thank you so much. Derek Wallbank, our senior editor, for us with the latest on that specific front. Let's continue that ahead of course, at this big meeting between the two presidents on China. And this specific angle, though, that Bloomberg has learned that the U.S. is actually set to impose an extra, this is tariffs and overcapacity, 7.5% tariff on Chinese goods. That's over allegations of manufacturing overcapacity. Let's bring in Min Milo, our China correspondent, here with us to tell us what we know so far. And this takes the level back to 20%, if I'm not mistaken here.
Yeah, and this hasn't been officially confirmed by the White House. It's according to what sources are telling us. And it looks like the Trump administration is prepared to impose these 7.5% tariffs ahead of the Trump-Xi meeting. And yes, as you said, it will bring the total to 20%. And this seems to be something that is still within the tolerance band for China, because both sides had agreed on a ceiling of 20% cap on tariffs. This was discussed in Kuala Lumpur last year at the sidelines of the ASEAN summit, and China has indicated previously that they would sort of be okay with this. So perhaps this will not inspire or spark any retaliation from China. But as just now Derek Wallbank was saying, there are other issues at hand, right? Whether the U.S. will take more concrete measures to compel China when it comes to its relationship with Iran. Of course, the tech issues are also on the agenda as well. So the timing is quite interesting, doing this ahead of the meeting, perhaps giving the U.S. some bargaining chip to try to compel China to meet some of their agenda.
It's interesting, too, if you add it to what they said about what Canada has been doing, right, retaliating with the U.S. with tariffs, and they hailed Canada with these sort of China-style tariff retaliation in their sort of trade fight with the U.S. What does that tell you about what Beijing's response might be to what we might be hearing here when it comes to fresh tariffs from the U.S.?
Yeah, I think if you compare it to Canada, the tariff levels are very different, right? And it's clear that the U.S. views China as a much more formidable opponent here. In terms of China's reaction, again, because of the previous commitment, I think China is unlikely to go back on their word, so that as long as it doesn't go above 20%, China might not retaliate. But there are so many other things on the agenda, particularly if the U.S. takes further measures to maybe blacklist Chinese firms in connection with Iran. And remember, over the last few months, there had been so many instances of the U.S. Imposing these bans on sectors like robotics, like drones, like routers and so on. And China has previously indicated they were going to take necessary measures to defend themselves, but they have not really outlined what concrete measures they're taking. So perhaps all of these will be under discussion in September when the two sides meet.
All right, Min Min Lo, our China correspondent there with the latest. So it's not just tariffs, it's also potential sanctions and the like here when it comes to Iran that China could be, really dealing with as, of course, Xi Jinping counts down to his trip to D.C.
Yes.
A few weeks away.
Yeah, that's about 4 weeks away, almost to the day there in about a month's time there. Asia, as you can see, is on offer, 0.5%. Some stability in the NASDAQ contract, but we're approaching the Chinese Open, and we are looking at futures signaling losses going into the Open today. Let's bring in David Savage out of our MLive team, of course, to talk us through what is top of his mind today as we look at the session and all things considered there.
Yeah, I think that the tech story is interesting. I mean, we basically on Monday had a pretty decent sell-off in Asia, led sort of by Samsung and some disappointment in its shareholder returns. And that kind of just carried over to the U.S. session, and now it's kind of recycled back into Asia. I think it's interesting because it's not just a tech sell-off. I think in the U.S. session, we saw actually the U.S. hyperscalers perform quite well. Software, again, held up better. But it's really been the chip story that's kind of continued to sort of sell off. And, of course, that bodes, much more difficult for, the likes of the Kospi and TAIEX and Japan to a lesser extent as well. So I think the semiconductor complex, which has really sold off essentially since the beginning of July, is really in search of a next catalyst to kind of reignite that momentum rally.
The NVIDIA earnings, is that going to be the catalyst? Or it seems like right now it's already seen as more of a sell the fact sort of event.
Yeah,
right?
I think it could be more positive actually for Asia. It has historically been a nice catalyst for Asia, even though it hasn't always historically paid off for U.S. shares. And I think it's too early to kind of really buy into this sort of rotation back to the hyperscalers. Sort of, there is, of course, a thought that, as the rate of change of CapEx spending kind of declines and you start to see some of the hyperscalers show growth in their cloud businesses and show, value from this investment, that perhaps that's where, investments start to rotate away from sort of the AI beneficiaries. But I think we're still early because, the hyperscaler basket has essentially been flat in 2026. So I think while you still have, very attractive valuations in the likes of the Kospi, I think that could still attract investors.
David, fantastic. Thank you so much. David Savage there. Out of our MLive team, futures are pointing lower as we count down to the opening bell here. Just, 17 minutes away. So we will manage to, as based on the information we have now, skirt a typhoon signal. Not so much losses still going into the open today. 17 minutes away. This is The China Show.
All right, your agenda here today, there is still some earnings, of course, that we are still in the thick of, right? So when it comes to XPeng, Luxshare, and Xiaomi, that all did report as well. So certainly that's one thing to watch. Alibaba, though, that's the big one. What would day two be after announcing this big share sale? Yeah,
I think the interesting new information we have there relative to what we had yesterday was, of course, the executives coming in and putting their capital behind really this AI fundraising plan. It's $15 million US, 120 million. It's really part of the news cycle here on day two as we approach that. We did see declines, though, overnight, still not to the extent of the Hong Kong session yesterday, but still, I would imagine, still under pressure today. And of course, that's really put this entire platform, OG tech universe, very much under pressure today. That goes into the earnings that are on deck today. So everything from Hotbot to biopharma, of course, and healthcare. We did get declines, by the way, overall. Hang Seng Tech, Hang Seng Bio Index, Hang Seng Financials were also under pressure on Monday. So we'll be looking at all of these things, of course, as we go into the session today. Joining us now to talk us through the markets and where sentiment is out of Shanghai is Yvonne, Overseas Strategy Senior Analyst at SWS Research, a unit, of course, of Shenwan Hongyuan Zhongquan, which is brokerage there. Good morning. So why don't we have a look at Hong Kong? The southbound flows have been on the lower side of things. Hang Seng Index 25,500. we've been stuck at this level for months now. We've touched this level multiple times over the last 12 months. How would you describe sentiment right now? What's the advice for Hong Kong markets? What's happened?
Well, I think that if you see the southbound trading in this year, so we can see that the southbound trading only account for around 20%, which is slightly lower than the average level, 25% in last year. So we think that if you see the market sentiment in this year, if you see the investor structure, the mainland investors, they even escape from the Hong Kong stock market, especially for those leading technology names in the first half of this year, especially from the second quarter of this year. So if you see not only the mutual fund, but also for those insurance companies, they just cut their allocation in the growth sector in Hong Kong market in the first half of this year. But apart from the growth sector, for those defensive sector, especially those high-dividend yield names like banking, utility, or even some materials names in Hong Kong market, these kind of stocks, they are favored by those long-term investors in mainland China, especially for those insurance companies. So we can see that for these kind of stocks, they outperform their growth sector peers since year to date.
Yeah, I mean, can you tell us what was going on with China Tech? Because the earnings season hasn't really fared too well. I mean, investors have definitely punished some of these big tech names for the amount of AI capex that they're willing to spend for this build out. I'm just wondering your thoughts on the earnings season so far and what's going to be the next catalyst, really.
Well, I think the second quarter is the darkest period for those internet giants in mainland China. So at present, if you see in terms of the fundamental side, especially for those core businesses for this kind of internet giants, they're slightly higher than the market consensus in terms of the midterm results. And also, if you actually, I think the market focus shift to AI capex currently. But for the AI capex or how to interpret the AI capex at present, I think that if you see the first half of this year, for many large internet giants, it is very hard for them to find a clear path to commercialization for those AI products. But now you can see that, especially for those AI agents, especially the official AI agent, become an important tool for those internet giants at present. So we think that in terms of the fundamental side and also in terms of the valuation side, it's very hard for those internet giants to come back to those low level in the first half of this year. But I think that it is still need time for the investors, especially those long-term investors, to see the potential catalyst in the future, where I think that the potential catalyst may come from the commercialization path for the AI services like cloud services and also some AI agent in the future.
So for investors, Yvonne, that want to invest long-term in China's high-tech future, what's the index they should buy? Is it the Hang Seng Tech Index? Is it the HKX Tech 100? Is it the Chinex Index? Is it the Star 50? What would you recommend? What's the best representation of China's tech future?
Well, I think at present, for the Asia technology names, especially those AI hardware equipment, the main problem behind that is if you see the crowded trading in the first half of this year for those mainland mutual funds, they allocated for more than 70% on the general AI hardware equipment in the Asian market, which is much higher than the so-called the standard for the crowded trading in the Asian market. So we think that in terms of the allocation side, it is very hard for them to keep buying these leading AI hardware equipment names in the Asian market. That's for Asia. But for the Hong Kong, you can see that not only for for the mainland investors, but also for the overseas investors. They are now underweighted the Hong Kong stock market, especially underweighted those growth sector in Hong Kong market, like internet, like Hang Seng Technology Index. So I think that in terms of the allocation side, the potential upside room for Hong Kong stock market is quite is larger than the Asia technology names, especially in the AI hardware equipment names at present.
I was going to ask your take on this news yesterday of Alibaba, right? Where they're tapping into the equity markets to fundraise, this $10 billion investment into AI. The market took it quite badly here. We're seeing the stock bounce back just a little bit here today, but do you think that was an overreaction, what we saw yesterday? What was your kind of initial impression of it?
Well, I think that just like I said before, at present, the core issue for the investors is not about the core businesses like e-commerce, like food delivery, these kind of things. I think the market focus shifted to how to interpret the AI capex. But now I think that if you see in the long term, like Ali, like Tencent, these kind of leading names, they are still important players in AI field, especially in China. But also maybe in the overseas market, these kind of companies and also some large model companies, they will rise their market shares in the overseas market. So actually, I think that it is the most important thing is that how to interpret the AI capex. But from my perspective, I think that it is a good business for them.
Yvonne, we got to leave it there. Thank you. Overseas Strategy Senior Analyst at SWS Research. As we were talking there, Alibaba shares up some 2% in the pre-market, but plenty more ahead. This is Bloomberg.
So Alibaba's up a little bit at your pre-markets, so we are getting a bit of a bounce there. That's lifting the overall benchmark. The opening bell, of course, is coming up next. We're looking at turnover specifically, and we will tell you why on the other side of this break. All right, good morning and welcome back. You're watching the China Show. So we're looking at some live pictures coming through, and you see why, of course. There is yet again another trading debut here in Hong Kong. Ingenic Semiconductor ticker on your screens, and that gong, which I believe is now a smaller version of what they tend to whip out every now.
Maybe because they have so many on stage, they got to kind of shrink the size of the gongs.
Yes,
how busy it's been in Hong Kong.
To fit everything in. Or is it the size of the IPO, which is proportionate to the size of the gong?
Oh, these questions we have to ask Bonnie Chan when we get her. But yeah, certainly there he is.
Yeah.
It's interesting that this is happening on the day where chips are actually not doing quite well against what we heard from NVIDIA. We saw we're in the longest losing streak in 4 years at a time when it seems like software is in some ways outperforming the hardware space. So we'll see how this one fares. But there you go. I think pre-market was unchanged at the moment, so we'll see how the rest of the day goes for Ingenic. The rest of the markets, though, are going to be doing like this here today. There you go. We're down some 3%. So following sort of the wave that we're seeing when it comes to clients across the board in the semiconductor space. Let's watch the benchmarks here in particular here. So Star 50, Chinex could be under pressure today, just given what we've been seeing in the hardware space. And there you go. They are leading the losses here right now. You got to add a little bit more of the geopolitics now, given what we heard from Iran. The threat of maybe secondary sanctions, or at least any country that does business with Iran, that certainly could weigh on sentiment here today. You also have sources telling us that Trump might restore tariffs on China to 20%. So there is a bit of flair of that as we count down, of course, maybe a month away exactly to that Trump-Xi meeting in D.C. see. So onshore equities are doing this under pressure here. Hong Kong, of course, we're still dealing with the Alibaba effect as well in some ways after we did see that 8% drop yesterday. Certainly, we did see the headline for when it comes to some of the founders, or at least the top Alibaba bosses, buying back 120 million Hong Kong dollars of shares in some ways to try to step in and support. But certainly, there you go. You are seeing a little recover just a bit, right? We're up about 1.5%. The whole BAT trade is also doing okay here, so recovering just a little bit. Earnings to tell you about, there's been a slew of it. So Leapmotor, Xpeng, Eoptolink, and Luxshare. Just to give you a whole kind of rundown, they're all falling here. Ooh, Xpeng. Following what we saw with the ADRs, it was down 8.5%. They missed the quarterly revenue from consensus. Also, vehicle delivery guidance also missed as well. So that is weighing on the stock. Luxshare actually, also was a miss there. Actually, Luxshare delivered solid first half revenue growth. But the stock is actually heading the opposite direction here today as well.
Yeah, okay. A lot to talk about. And of course, Leapmotor, right, as we were pointing out, will be joining us later on the show. It is the top-rated automaker. When you look at consensus ratings, buy, sell, hold, it's almost got a perfect score on the street there. Okay, let's get a sense now, just some final thoughts with Yvonne, who joins us from Shanghai today. Overseas Strategy Senior Analyst at SWS Research, a unit of Shenwan Hongyuan Securities. You note here that the domestic demand sectors, there's quite a large gap between actual and expectations. What's the mood like on the ground there, given the weak macro that we've seen out of China?
Well, I think that the core reason behind that is how to see the housing price in China, especially in the tier 1 cities. So now I think that actually we think that the housing price in China, especially in top tier cities, may go stable. The main reason behind that, if you see the rental yield is slightly higher than the risk-free rate in China. So that's why we think that the housing price in top tier cities in China will go stable in this year. So if the investors see the signal, we think that they may change their view on macro economy very quickly, and also given their low allocation on domestic demand sector like consumption or like even financial sector. So we think that the potential upside room for those non-AI sector, especially for those domestic demand sector, may have a better performance than the first half of this year.
Okay, I guess final question then. If we are near that inflection point, if and when the macro does turn, and a lot of people are expecting at this point, given the data, maybe some more support is needed. What is positioning looking like in the A-share market where you are onshore, Yidong?
Well, in the Asia market, I think that I have to say that many local investors, they are still very cautious about the macro economy at present. So that's why when they lost in the AI hardware, on the AI hardware equipment sector, they started to focus on those high dividend yield names in the Asia market, like financials, utilities, or even some consumption names with high dividend yield names. And also, on the other hand, there are a lot of companies, they are wait to go public in the Asia market, especially in Chinex board or even Star board in Shanghai Corporate. So we think that, but the market sentiment started to cool down over the past months. So we think that if we still need these companies to go public in the future, especially in the Asian market, the investors may change their focus to some other heavy-weighted sectors in the Asian market. So that's why we still hold a bullish view on board indexes like Shanghai Corporate at present.
Yidong, always great to have you, Overseas Strategy Senior Analyst at SWS Research. Please come back. It's great to get your perspective there this morning. Let's talk a little bit more about this news on Xiaomi. It's launched a mobile processor for its marquee devices in a move that will put pressure on some longtime suppliers like Qualcomm and MediaTek. Let's bring in our Bloomberg Intelligence Senior Technology Analyst, Stephen Chung, joins us now. We see the stock up 1.5% and perhaps in reaction to this news. Tell us a bit more about this new X-Ring 03. Is that what it's called? How does it differ from its peers or what we see in the industry?
Okay, I think compared to other more advanced processors, which are all moving toward 2 nanometer now, I think this chip still stay on 3 nanometer, but it does have some redesigned core, better memory, and also better on-device AI capability. So I think to some extent, Xiaomi tried to demonstrate that they can improve the chip performance mainly via design capability rather than just process upgrade. So, but then this is really a long-term effort for the company.
Yeah, and it's developing its own chip now. You have obviously rising external component costs.
Yep.
Is this something that you think will save the company money, and what does it mean for outside suppliers then?
Obviously not now, because at the moment the volume is not big enough. But if you look at other example like Apple's case, where they use a lot of domestic locally, its own silicon, which actually save a lot of cost. So long term, that's definitely a worthwhile effort. But at the moment, I think it still takes time. The volume, as we see from the news, is really just about 200 to 300,000 units, while Xiaomi for first half, its smartphone shipment has been 65 million. So, I mean, that obviously means that they still need to count on the third-party chip supplier.
All right, Stephen, fantastic. Stephen Chung there, our Bloomberg Intelligence senior tech analyst there. Let's have a look at earnings. So PDD revenue, that's, of course, the owner of Temu. So you had it missing expectations there in 2Q that's ahead, even as you had EPS coming in ahead of expectations. And the focus is now shifting to the outlook for Temu and the costs of operating in an increasingly regulated environment.
Yeah, let's bring in Bloomberg Intelligence's Catherine Lim. She's here and in town to walk us through the earnings here. What did the quarter say about PDD's China business?
Right. That's the number that I think, most people actually forgot, that PDD's, the bulk of their earnings is actually still coming from China. And if we look at that number itself, and that the one to take note of is the online marketing services, is actually trailing the entire online retail sales growth that we've really seen. And the reality is that, consumption isn't great, merchants aren't spending, and more importantly, PDD is actually subsidizing. Some of the merchants, they have a 10 billion program that's out there that they are literally getting, I guess, their merchants to be more compliant, with their product qualities, etc. So I think the focus for PDD isn't really trying to monetize, their platforms, their merchants, but, more importantly, trying to actually help some of these Chinese merchants itself get to speed on compliance, etc. So they're not in a rush to actually, try to get more out of them.
It then begs the question with this other listing that's coming. The very first night of September, as Earth, Wind and Fire said, which is, of course, the listing of Shein, September the 1st. What does that tell you about how much Temu is probably worth?
Right. I love it when the rivals actually, decide to actually make an announcement on the same day itself. But really, I think if you actually look at 7 times PE for PDD, you do question how much is being paid for Temu right now. And essentially, stripping out China, I would say it's quite close to zero. And the reality is that when Shein actually, goes public itself and has a market value to it, are we giving the right valuation to Temu, which is still growing in the market? But the reality is that it is a third-party business versus Shein. The business models differ itself, but it will be really interesting to see how the valuation gets closes.
All right, Catherine, it's great to have you. Catherine Lim there, our Bloomberg Intelligence senior consumer and technology analyst. And of course, there's much more when it comes to China earnings. In our next hour, we're going to be joined by Beijing Leapmotor's co-president Michael Wu. He joins us exclusively after net income jumped more than 5-fold in the first half, with analysts staying bullish on the outlook there. We're plenty more coming up. This is Bloomberg.
I mean, yeah, it is the summer, so we are getting activity somewhat slowing. But also, when you look at turnover, it's certainly not the story when you look at the IPO market.
Oh, yeah.
But it is turning over overall. So it's day 2 of sub 3T on the onshore markets. So low turnover is something we'll track. We'll see if we get a third day of sub 2T. Today.
Yeah, so as you mentioned, right, we've been so busy when it comes to these listings, whether it's Unitree, CXMT this summer here. We have, of course, Yangtze Memory Tech coming up as well. But there seems to be a bit of a disconnect between these blockbuster listing debuts and a languishing broader market that's worsening in China. And that's left investors hunting for a fresh trading narrative to revive a new or a potential stock rally. Let's bring in Winnie Xu, our Asia equities reporter, who is talking a little bit more about this taking stock piece here today. How are investors looking at this sort of disconnect?
Yeah, it is quite a big contrast, right? Because on one hand, you have these blockbuster IPOs you just mentioned, Unitree and also CXMT. So since their July debut, average jumping about 370% since then, versus when you look at the broader market, Star 50 down about 27%, and CSI 300 also lower by about 8%. So that stark contrast, on one hand, it's showing you that there's so strong appetite for the IPO market, and that is actually just a mirroring effect itself of how weak sentiment is for the secondary market. And of course, that comes in different folds. First, you have just a broader risk-off sentiment globally because how yields are staying very elevated. But on top of that, we don't have much of a catalyst. And obviously, today's tariff news is really not helping sentiment as well. Then the broader macro picture for China not looking great with the latest set of economic data points, pretty much disappointing across the board. So with that, you are really seeing investors turning more negative. You just talked about turnover. So when you look at that level, it's pretty much at the lowest level since April. So yeah, like really lacking kind of that momentum there for the Chinese market.
And is that directly because of all the fundraising that's going on? Like tie everything together from the weak, the soft macro, and obviously the blockbuster fundraising we're seeing elsewhere.
Yeah, so, we talked about the global weak sentiment, and then we talked about the macro weakness in China. But when it comes to the fundraising, the effect of this, lots of fundraising really going on, right? Because yesterday we heard about Alibaba raised $10 billion US for that's the Hong Kong's biggest secondary share sale, right?
Ever.
And on top of that, you have Yangtze Memory that just submitted their listing for approval on the Shanghai Stock Exchange, right? So that is, I think, looking at around $5 to $6 billion US dollars as well. So all of this, obviously, it's raising some concern in terms of how money has been pouring into investment, which has not really been showing up in the monetization side of things when you look at how earnings overall have been pretty weak. And then on top of that, for the broader market, the worry is more about how that can suck up the market liquidity as well.
Winnie, thank you so much. Winnie Xu there with the taking stock piece of the day, our Asia equities reporter. Let's have a look at some of the corporate stories we're tracking at this point in time. We're watching shares of Xiaopeng. We should be, there we go, we're now down 6%. It's after third quarter forecasts for sales and shipments, missing estimates there. Now, it expects vehicle deliveries of up to 121,000 units for the period. That's compared with analysts' forecasts of about 147,000. Meanwhile, XPeng says its robot unit plans to raise $900 million from investors, including Alibaba and Tencent, bolstering its push into humanoid robots. Now, Bloomberg has been told that Taiwanese prosecutors have indicted a senior NVIDIA manager as part of a group that allegedly smuggled advanced AI chips into China. Sources say 2 senior employees of Supermicro Computer were also indicted. Now, they are accused of organizing the shipment of 74 servers containing high-end V300 chips into China via Japan and also via Indonesia in breach of U.S. trade restrictions. Now, the U.S. SEC is said to have sent subpoenas to major Wall Street banks over the hedge fund situational awareness. Now, sources say it's seeking information about trading activity at the hedge fund, which came under pressure, of course, as you all may have seen last month. Now, situational awareness liquidated some of its positions amid this barrage of margin calls, including or during this stock rout that took place last month before Citadel, of course, stepped in to buy the bulk of its bets. Okay, we'll just take a short break. We'll leave you with a very quick glance at cash markets. We're about 18 minutes into the session today. Uneventful so far. It's quiet. This is The China Show.
We haven't bought a single bond yet. The next time we have an operation is September 9th.
All right, that was, of course, U.S. Treasury Secretary Scott Bessent responding to questions about whether he will increase bond buybacks in the near future. I mean, that was the big sort of speculation, right? I think it was CNBC that reported overnight that they might be tapping into, of course, this general account, into their cash pile to actually fund all of this as well. That was the clarity that we got from Scott Bessent, but still a lot of lingering questions of really how this is going to impact the dynamics really on the long end of the curve moving forward.
Yeah, I think they're modernizing their toolkit, right, to deal with the rising rate environment. And it does seem they do have enough. Like, what does this excess cash actually mean? What is spare cash, right? And how big is that? How big is that war chest? I think we'll really have to wait for them to actually then tell us if they had come into the market. It was clear at least what the line in the sand was.
Yeah, and I think
on the 30.
You're still getting a lot of commentary about this whole bond buying program, right? I think Citadel was the one that said this is almost like financial repression in some ways when you're trying to anchor levels on the long end, when at a time when the economic forces are so strong, right? This resilient economy and then all the things that, that would bring yields actually lower are things that the U.S. doesn't want. Right. So certainly that's the big sort of contention that we're feeling in the bond market here these days. We also heard from the Guggenheim CIO and Walsh, who told us more about why they see higher Treasury yields as a potential buying opportunity.
Here we are in a trading range on the 10-year. And at the low end, we've been down into the high threes. At the high end, we're 470, 475. And at 475, that's pretty much the high end of our range. If we see 5% on Treasuries on the 10-year, I would tell you that is a buying opportunity. I think the markets aren't able, particularly the equity markets, aren't really able to function as well beyond that. And I do believe it tightens financial conditions. The 30-year, however, historically has traded much more on inflation concerns. I don't see us going to 6% on the 30-year. And if it does, I would take the opposite view and I'd back up the truck. And I'd buy a lot of 6% 30-year Treasuries. I think that at this point in time, what we're also seeing, I said stratification earlier, we're seeing that also in the pull up. Another factor that's happening, and that is the sheer amount of debt that's being issued, not just at the Treasury level from fiscal spending, but also because of data centers and AI trade, the AI trade that's happening at this point in time. And as a result, we're seeing this very significant amount of need for capital, and they want to issue in the long end, which is pulling rates up.
Do you want to invest in that debt, long duration, hyperscaler debt, or do you see that as potentially more toxic than U.S. government debt should things turn south?
I think there are other parts of the infrastructure trade that make a lot more sense. Power build out and other kinds of long-term real asset investing. My concern about the data center build out and the cost of that is the obsolescence risk in the long term. Now, I am selectively an investor in shorter duration offerings, but we have to be thoughtful because the AI offerings that are coming out of the capital market are not in just one place. They are in unsecured investment grade credit, they're in structured credit, they're in infrastructure. So you have to be really thoughtful to make sure that you're getting the right amount of diversification.
And Walsh there speaking on Bloomberg surveillance, of course, the CIO there at Guggenheim. Okay, just very briefly as we go into a short break and into the second hour of the program here. So gold stocks are seeing some downside right now. It's worth pointing out we are still up on the gold price, whether you're looking at some futures contracts or the spot price. Overall, I think when you look at the gold price and the momentum there, we are now exhibiting some signs of overheating, short term at least with the 14-day RSI on that. Hasn't been above 70. It is now. Hasn't been above 70 since we were touching all-time highs early this year. Hang Seng Tech Index on your screens. China's feeling the pressure, of course, of the downdraft across the chip space, and we are underperforming as far as that's concerned. Some bright spots are emerging in the form of, I think you look at banks are doing quite well. Biotech is also, again, providing that counterweight to just broadly speaking the tech sell-off that we're seeing just about across the region. That's on your screens as well. 0.6 to 1% on the banks index. We have plenty more on the way in the next hour of the China Show.
second quarter is the darkest period for those internet giants in mainland China. So at present, if you see in terms of the fundamental side, especially for those core businesses for this kind of internet giants, they're slightly higher than the market consensus in terms of the midterm results. For the Asia technology names, especially those AI hardware equipment, the main problem behind that is if you see the crowded trading in the first half of this year for those mainland mutual funds, they allocated for more than 70% on the general AI hardware equipment in the Asian market, which is much higher than the so-called the standard for the crowded trading in the Asian market.
Yeah, it was fantastic sort of commentary from Yvonne there from SWS Research, just talking about positioning, where we're looking at in terms of the earnings picture here, the darkest period when it comes to China tech here right now. The Alibaba news, I mean, yesterday certainly did dampen sentiment. At least we're seeing a little bit of recovery here today, but certainly a lot of lingering questions on what, this looks like, right? This financing wave that we're seeing, pair it with listing debuts, and really you're seeing it paired with a market that is lacking some catalyst too. So
and a weak macro.
And a weak macro.
At that, where a lot of their core businesses, legacy businesses, are still tied to, whether that's e-commerce and Alibaba, the gaming business and Tencent. You look at some of the ad revenues there. Baidu is going to be very much in focus too. That's coming up on your screens. And when you look at that, not that they're not growing, because they are growing, but when you compare them to the sort of expectations we have for the other tech companies, and then now they have to spend to become the latter.
Yes.
Now, companies, investors are now, I would say questioning, but there is a transition period where we kind of have to make up our mind whether it is worth spending that money. And it clearly, when you look at some of the news flow coming through, and you have the founders of Alibaba putting money behind this cash raise, underscores that they're in this for the long haul. But yes, as you can see on the screens, I mean, Baidu's trading at below 90, right? This is back to levels of 12 months back. We're below 440 on Tencent, and we are still at about 110 on Alibaba. That's also relative to what we're seeing across the region, doing better, because this is what we're seeing across the chip plays there, Samsung, Gold, all the way down to Advantest. Nikkei topics, Kospi and Taiwan coming up on your screens. This downdraft story is playing out on an index level as expected. Gold is still seeing some upside, as with silver last we checked. 80,000, of course, on Bitcoin has been very much in focus too, and Shanghai crude on your screens too. We're up a touch there on maybe the geopolitics complex here as well.
Yeah, in the form of sanctions and the form of tariffs too. So two sort of stories that have emerged overnight here. Let's get to that. The Trump administration is stepping up its pressure campaign on Iran and warning that companies and countries helping Tehran evade sanctions could face consequences. And here's what he said when a reporter asked whether Chinese entities would be covered by these sanctions.
Chinese banks have often been talked about being targeted, but we don't see any of those institutions targeted here. Is that something that is coming in this campaign, or is the very delicate trade truce with China something that could prohibit you from going that far and taking that very big step?
We want to make clear here today that no one is above the reach of U.S. sanctions, that if they facilitate transactions and are part of the ecosystem that turns Iranian oil into money, into repression, they will be targeted. We find that the best way to engage with countries is through quiet diplomacy, and we are level setting with every country to tell them our expectations. We know who they are, they know who they are, so when the hammer of U.S. Treasury actions falls upon them, they will have no one to blame but themselves.
John Herskovitz is our East Asia government editor, and he's with us right now to talk us through this. John, well, first question is the impact. What would it have, given what Scott Bessent just laid out there? And also, how much is China actually being targeted here?
Yeah, I think the immediate impact is far less than what the rhetoric suggests. Bessent was very cautious not to mention Chinese banks. And the thing is that if the U.S. really wants to go after Iran's finances, it has to pressure China. China purchases about 90% of Iran's oil exports. It's its main conduit economically to the outside world. And if the U.S. were to go after the banks, with Bessent's announcement, he was very clear not to touch banks or refineries. If the U.S. were to go after these, it would risk a trade war with China. And China could retaliate in various ways. Also, Bessent doesn't want to upset China ahead of a summit with Bush and Xi Jinping scheduled for next month. So I think what we saw here is more of a warning shot than the full-scale economic assault that Bessent has framed these actions as pertaining to Iran. So a lot of caution here, and I think the rhetoric really is dependent on the enforcement mechanisms, and we're not seeing those yet on China, its banks, or its refineries.
It seems like, though, according to our sources, that Trump is trying to resurrect a little bit of the trade policies with China as well, right? In terms of these potential tariffs they're talking about due to concerns of excess capacity and the like. What impact could that have, essentially, here, of course, as we count down to those Trump-Xi talks?
Yeah, I mean, what we have some reporting from Bloomberg is that the Trump administration is looking at imposing a 7.5% excess manufacturing capacity tariff on China. This would be in addition to the 12.5% for forced labor. And this is a way to ratchet up pressure on China, but it's a calculated way. China and the U.S. have looked at about a 20% limit on the tariff, so 7.5 plus the 12.5% at the 20% level. And it's a way to get Xi Jinping's attention ahead of the summit, but in a way that also doesn't exceed the limits that the U.S. and China have been playing by over the past several months as they've tried to take the heat out of their trade war.
All right. John, thank you. John Herskovitz there, our East Asia government editor, on these two top stories here this morning. And, when it comes to Bloomberg Intelligence, Dave, it certainly means, a lot of questions about how crowded things are, right?
Concentration risk.
AI seems to be dominating a lot of investor portfolios here. And this hunt for alpha could be set to intensify among fund managers in the region as we start to see that concentration risk grow. Joining us to break down their latest Asia ex-Japan fund manager review is our senior equity strategist, Marvin Chen. So tell them more about positioning and what EM funds are doing now.
Yeah, I mean, in our latest review, it's showing that EM funds are generally underweight Asia tech at the moment, and this is a reflection of the rising concentration risks in the region. Previously, these underweights were really driven by TSMC, just given how large the company is, but more recently, the Korean chip makers SK Hynix and Samsung are also adding to this risk. If we just look at these three names, they make up 30% of the EM index. North Asia as a whole makes up nearly 70%, the highest in over a decade. This concentration risk is really making it challenging for EM managers to match this kind of exposure. And we're seeing big, wider dispersion of performance across these funds.
Yeah, we've seen momentum really as a factor, the momentum factor really fall out. And tech momentum obviously is part of that story. Which markets then stand out if that continues?
Yeah, I mean, obviously we would look at some of the markets that have kind of lagged during this AI rally, Southeast Asia, India, but we would also look towards China. China is obviously one of the broadest, most diverse, and most liquid EM markets in the region. And if we look outside of tech and the consumer space, energy, materials, healthcare, these sectors have kind of macro and more global drivers that are kind of outside of the China domestic demand picture.
You mentioned that EM funds are overweight China. That's due to a technicality. What do you mean by that? And what do we make of it?
Yeah, I mean, what we're trying to say is it's really a byproduct of how fast the EM landscape is changing. China's weight in the EM index has fallen to under 20%. This is down from a peak of over 40%. So really, the decline has really accelerated over the past several quarters. So really, this overweight position is a reflection that EM managers have not been adjusting their positions as fast as the changes have been coming. Also, during the rally in Korea and Taiwan, we know foreign investors have been net sellers of the markets. So these markets. So China has been a beneficiary of some of the rotation. As these managers rebalance.
All right. Marvin Chen, thank you. Bloomberg Intelligence Senior Equity Strategist. We're laughing because we keep stealing each other's lines.
Yeah. That was my part of the script. That was my part of the script.
The prompter says David, but somehow I keep reading. I'm sorry. I didn't mean to do that.
You're stealing my thunder.
You can read this
here.
one. This one has my name on it. You can read it.
But this is very difficult to read, though.
Yes, you can do it.
Okay. China's Leapmotor posting a 57% jump in first half profit. Okay, Leapmotor joins us next. Fantastic set of earnings. This is one of the street's favorite stocks in the sector, and the co-president joins us in a couple of minutes. It's great leap forward, as we're saying. This is the China Show. Right, welcome back. Let's talk about earnings. Zhejiang Leapmotor, as we were pointing out, is really one of the top-rated, if not the top-rated, car maker based on analysts' buy, sell, holds, consensus ratings, almost a perfect score, not a single hold or sell in the stock. The company's growing leaps and bounds, 530% jump in net profit in the first half. You have vehicle deliveries accelerating past estimates. It's the automaker, as we were just pointing out there on your screens, is the street ratings. What do you do with the stock is basically the question here. Joining us exclusively to talk about the earnings and the outlook is the co-president, Michael Wu. Michael, good morning. Thank you for joining us. I believe this is the second straight 6-month period where you are profitable, so momentum is certainly there. Just talk us through the highlights for you, Michael.
Yes, good morning, David. This indeed has been our third 6-month period with the profitability since the first half of 2025. For the past 6 months, we have indeed achieved quite a number of milestones. Firstly, we continue to deliver very strong units. We have delivered more than 356,000 units in the first half. And for the past 5 months, our monthly sales has been among the number 4 among all the global new vehicle companies in terms of sales. And also our market share by the end of June has reached 5.7% in China. That's up from 4.2% in the first quarter. And so despite the industry-wide pressure, we have done well in the delivery of units. And also in the first half, we have launched a number of new vehicle models, which has been selling pretty well. In terms of overseas, now the overseas sales in the first half has accounted for 27% roughly. So in the first 6 months, we delivered 96,000 units, which is more than the whole year of 2025. So for the whole year, we were targeting to achieve 200,000 units exports in the overseas market. So that's slightly up from our earlier targets. So overall, it's a quite balanced and a good quarter and a half for us. I'd say we're on track in managing and delivering executing our business models.
I guess the one sore spot, what the analysts are flagging is your gross margins, which did take a bit of a meaningful dip in the first half here, but you still guided higher, 13 to 14% for the full year. So, you are implying in some way some sort of margin recovery. What do you think is going to be driving that?
Yes. The margin in the first half was under a bit pressure because of, as you know, the competition, some raw material cost increase in the period. But the improvement will come from increased sales volume in the second half and our continued cost-cutting measurement from our R&D and also our balancing in supply chain, in new products, mix, and cost-cutting.
Okay, well, let's talk about deliveries then. And I think we're flashing on the screens, Michael. These are the estimates, I should note, from analysts and not the company. And you pointed out, of course, your target, 200,000 overseas. Do you think there's a chance that you get to 1 million vehicle deliveries for the full year of 2026? Just help us understand the volume scenarios here that the company is penciling.
Yeah, David, as you see on the chart, we're on track in delivering that 1 million units. In July, as you just noted, we delivered 101,000. And from August to the rest of the year, we're on the track of delivering more than 100,000 units per month. So when you add them up, plus the first half, we're very much achieving the 1 million units for the year.
What gives you so much confidence? I feel like, it's great that you're hitting these milestones, Michael. What gives you confidence that you can sustain this momentum, right? What are you seeing domestically on the ground when at a time when your macro picture seems to look pretty weak? We've seen these price wars in the industry that really kind of weigh on the sector. But what gives you confidence for this recovery, you think, Michael?
Right, Yvonne, that comes down to our business model. Leapmotor's cars ranges from 60,000 RMB to 300,000 RMB. And with all our products offer the very good quality with affordable prices. So that gives us a tremendous competitive advantage. And also we offer the customers the value. The reason we can offer that kind of a competitiveness in the products is also our fully integrated business model. We develop and manufacture all of the key electronics components, plus some other components in the car. We have more than 65% of the value of the car is all in-house developed. So that gives us a tremendous amount of the flexibility, but also cost control ability. So we want to give that kind of a cost saving to the customers to provide the value to them. So this is the same logic across all our car models. So that's why we're confident our products will continue to sell well and reaching that sales target for the year.
Michael, do you want to see that percentage of what you control within making your own in-house components rising over time? Given, of course, to your point, we live in a world where components are the bottleneck for many, many people and many companies. Do you need to raise that percentage even higher? Are you happy where that stands currently?
We're actually in the process of making more and more components in-house. Currently, we're more than 65% value produced in-house. We're going to reach 70% in about a year or two, and eventually increase that between 70 to 80%. So that's an ongoing process.
Obviously, we continue to watch the development of AI and all this innovation that's really kind of emerging in China now. I know, Michael, you guys are looking at maybe even talking about robotics as well as part of your sort of moat, according to what we've been hearing as well. Yeah. How do you see these sort of the industrial side of things, the robotics side of really fitting into your core business now?
Yes, indeed. We do have a robotics strategy, which is to develop that to fit the industrial space first. And then, between the EV cars and the robotics, we pretty much share the similar set of supply chains, similar capabilities in a lot of hardwares and softwares. By the way, Leapmotor in the first half, we have made great progress in our autonomous driving algorithm and development. So we have made a very strong progress. In mid-September, we will invite people, investors, media friends, to come to our company to experience our latest ADAS-related capabilities. So these things, plus other supply chains in the EV industry, is very much applicable to the robot industry. That's why you see these two things are naturally within the realm of companies like ours.
Michael, the overseas business is obviously part of the company's plans. Localization, your network in Europe, South America is something that you're prioritizing. Help us understand what the blueprint is currently. How much do you want to see that your assets outside mainland China grow specifically?
Yeah, our business and assets outside of China is all through working with our great partner, Stellantis Group. In terms of localization, we're also making a very fast progress. By October this year, we will mass produce one of the models in our Spain factory, which is also owned by Stellantis. So we work with a partner to get the production in good shape. And the next year, there will be the second model to be produced in that same factory. And other regions, in Asia, we have identified several sites, one of them in Malaysia on a smaller scale to produce locally and sell it locally. And South America is one of our also strong regions. So we have identified also one of the Stellantis factories in Brazil to turn that into a manufacturing hub for Leapmotor cars.
All right, Michael, we ran out of time, but we could kind of talk through the next hour about this. Michael Wu, co-president at Zhejiang Leapmotor Technology there, of course, on the back of their earnings, and on track to deliver 1 million units this year. That certainly could be a pretty pivotal milestone for the company. All right, take a look at Bitcoin, another milestone as well. We're hit 80,000 for the cryptocurrency for the first time since mid-May. You got to thank the weakening dollar. That really is kind of helping this, given what we heard from Scott Bessent, this whole bond buying program, and really that it continues to help the likes of gold and Bitcoin as well.
There we go. 80K. This is Bloomberg. Okay, we're looking at some bright spots. Really stand-up bright spots across the Chinese markets. Biotech is back, given, of course, the downdraft we're seeing in tech. It's almost this barbell strategy that it's either or on any given day. This is doing well. The banks are doing well. Some construction stocks, by the way, are going to come up on your screens as well very, very shortly. On the bio index, we're up 1%, and some of the names there on your screens. Up 5%. Hong Kong is awarding this project to this consortium?
Well, yes, because it's all about the Northern Metropolis now, right? So you're starting to see this project, I guess, gain a bit more traction. You get a little bit more news about this as well. It's not just some idea or some concept anymore. So they awarded that Hong Shui Q pilot area project to HSK New Development for about $130 million. So that certainly is one that's like China Overseas Land, China Merchants, China Resources Land. They're part, of course, of that consortium. We have plenty more to come. This is Bloomberg. Hey, Tokyo, it's 11:29 a.m. over there. Japanese markets heading to that lunch break. And we're still above water, but we're pretty flat when it comes to the Nikkei here this morning. But certainly this is coming at a time when you are seeing some pressure across the chip sector here in the region. You are seeing here not much movement when it comes to dollar yen, a little bit of weakness, but we're still talking about 290. So yields are still ticking higher on the JGB curve here this morning. The rest of Asia, though, we are still seeing some pressure today.
Yeah, I'm blaming the Philadelphia Semiconductor Index. I'm blaming the chip space.
Blame NVIDIA.
Blame NVIDIA, which is down successive days now, I think 6 or 7 days. The longest losing streak going into the earnings season. Well, longest losing streak in and of itself in several years on NVIDIA itself. And I think what's the hyperscaler story, and this time last year, people were telling us bet on the broadening out of the AI story, which, by the way, has happened, right? That's exactly why we're flat on the hyperscalers, and we're looking at now the more depiction shovels trade. That's just to say a lot of that is in Asia Pacific, and a lot of those big winners are seeing some profit taking today. With the IT index down 1.5% as far as that's concerned. Asia is down 0.4%. Just a note, too, when you look at the likes of Alibaba, we're seeing some stability there about an hour into the session there. But on a benchmark basis, we are seeing some pressure, specifically onshore with the Chinex index really leading losses onshore currently.
Yeah, because you're starting to see hardware get hit quite a bit here, right? Ahead of those NVIDIA earnings there. And so software, given it's more asset light and the like, maybe that looks good in the face of all these concerns about AI spend and the like. So certainly that's sort of where the market is tilting towards and shifting to these days here. But we're also talking about property as well. JLL, Property Consultancy, they say that luxury home rents in Hong Kong should rise a further 5% this year as a booming financial sector brings more expats to the city. Joining us now is JLL Hong Kong Senior Research Director Cathie Chung. Cathie, it's great to have you. So, certainly we're seeing expats come in. We're talking about expats returning to Hong Kong as well. Just walk us through what's really driving sentiment here right now.
Sure. We're seeing expats coming and also returning to Hong Kong, especially actually in the first half of 2026. We already see the growth increased by 20%, which is like the strongest growth comparing to the last 3 years. And what's driving? We can see that most of the expatriates are coming, like initiations are coming from the finance sectors. So a lot of hedge funds, wealth management companies, and investment banks are expanding in Hong Kong, and they are relocating, like bringing international talents into the city. So this fuels the the residential demand, also the luxury residential demand, and driving the all-time high luxury rental or overall residential rentals further. As well, actually, their demand in the expansions in the office market also sustained office demand, especially in Central.
I'm curious what your insights are. So expats are coming back. Are expat packages returning proportionately to the city? Because there was a time where you had a lot of expats, but the packages that we've had in decades past were no longer being offered to as many people. Because that goes into luxury rents, right?
Yes. Actually, not only luxury rents, also into like from the early careers, professional, as well as for senior management. So it's the package like it's also for a wide range of individuals or seniorities are coming back. Yeah.
And where are they coming from? Is it mostly from the mainland, or where are you seeing in terms of mix of geographies?
Yeah, in terms of geography, we see a lot are coming from the Europe, especially for those Europe and the US, especially for those in the financial sector, and then some are for the retail sectors. They're coming back from the Europe, and then the tech sectors are mainly coming from mainland China. So it's quite a mix, and also some from Singapore and Japan.
And what are the incentives? So, if we had to pick 2 or 3 reasons why expats are returning, what are the underlying conditions that seems to be brewing?
Yeah, there are mainly 2 drivers that we saw. One is the reviving IPO activities, and the second is the expanding wealth management sector. So these 2 sectors actually, based on our discussions with the financial sector clients, the location preference of new funds setting up in Asia has totally reversed from last year. So last year, 2 to 3 out of 10 of those funds will choose to set up in Hong Kong. However, this year, the number has changed, totally reversed, like 7 to 8 are like choosing Hong Kong to come.
There's a lot of talk about this new tax regime and even, massive tax breaks for people in the hedge fund industry, and all these proposals that are in place in Hong Kong. How do you think that changes the dynamics of the residential market?
Yes, I think those are like tax funds, are like tax regime, tax exemptions are going to be a major increase the appeals of Hong Kong as locations for them to work here and for the firms to expand here. So the relocation or the bring in of international talents of high net worth individuals into the city will drive a luxury residential leasing demand as well as the rentals.
And the outlook, so where are we in this cycle? Are we at peak, past the peak? Is the peak still ahead?
Yeah, the peak, we have been residential rents has been breaking record for continuous 19 months already. And we expect rents to move further by about 5% for luxury rents for this year.
What about commercial?
Commercial
recovery now?
Yes, we're seeing a recovery in the commercial in the office sector, and it's the verifications. Most of those recovery are driven by those in high quality buildings, trophy buildings.
Central.
Central and trophy buildings. So for rentals, for central rentals, it's already recovered about 8%, increased 8% year to date, and for the full year, we expect rentals to increase 10 to 15%, which we believe is on track.
What about supply? So how are suppliers of apartments and offices react? Obviously, it's a very big lag. It takes years to put capacity online, but where do you see capacity over the next 5 years then?
Yeah. Actually, right now, it's interesting to see that quite a few service apartments, as well as the en-bloc residentials that are previously for lease, are like sold for convert into student accommodations, and some of the residentials are strata for sales. So the leasing stock has been reducing. That's why there's an imbalance of supply and demand and pushing rentals further up.
How much appetite is there in this whole student housing thing? It seems to be something that people are talking about. We just had the Henderson Land CFO come on saying, it's not something that's a priority for them, but because in some ways it's quite tedious and costly to do so. So how much appetite is there to convert these commercial buildings to student housing?
Conversion from, like previously, the conversion were mainly from hotels as well as from residential. But because of the last one or like 12, 16 months, the market has already a lot of conversion or transactions of hotels. So those like cheaper stocks are already sold out. So quite a lot of investors are looking into the Grade B, Grade C offices potentials to convert into student accommodations. However, having said that, as you mentioned, there are a lot of difficulties to overcome, like because of the technical as well as the financial viability and technical viability. So it depends, like on individual locations and buildings. A lot of due diligence has to be done.
Well, how bad is put it into context first, how bad is the shortage for student accommodation?
Right now, we expect the shortage is over 70,000. Like the shortage, yeah. Okay. But the shortage in the beds is going to expand further, even though with a strong pipeline. But having said that, we must say that even right now with that shortage, a lot of them still have homes to live in Hong Kong, so they go to other options, for example, private residential leasing.
They do
and
rent that.
Yes, and that contributes to the rise in the rentals, as well as also like friends' homes and
friends' couches, family, friends, and spare rooms. If you have an extra room.
If you have an extra room, I mean, square footage in Hong Kong is such a hot commodity these days as well. In terms of risks, though, what are you seeing a risk on the horizon here? Obviously rates are moving up. There's certainly that is one thing. But what do you see as the sort of the lingering risks that we might have to look at for the rest of the year?
I think two things. One you mentioned about the rates, but the interest rates. I think the interest rates, we are not too worried about the moderate increase of interest rate. For example, this year will impact on the affordability, but more on the financing costs of the developers. So that will push pressure for them to control in their first-hand launch pricing. And the second one is on the policies, as we discussed about the potential threats about the control of capital flow as well as the cross-border income tax. So that we believe in the short term it might affect the sentiments, and which has already reflected in the transactions in July, and which drops about 40%. And but in the mid-term to long run, we believe investor will rationalize the cost, because it is additional cost, just like the previous buyer stamp duties. They will build into that cost into the formula and rationalize. So all in all, we believe the demand will not disappear, it will adapt.
Okay. What about, just I guess it's a final question. So we know finance is back, and that covers everything from financial professionals, legal professionals, everything that has to do with the deal team in the IPO market. What about tech professionals? Because the government has been pushing to get tech talent into the city. Are you seeing that portion come in, and are there preferences where the tech bros prefer to be located?
Actually, it's interesting. Like we also see the techs are coming with relocation, mainly coming from England. And in terms of housing budget, actually we see different housing budgets provided to different industry. For investment banks, highest budget. For tech, it's relatively on the lower end.
Okay.
Yeah.
Cathie, it's great to have you. Cathie Chung there, Senior Director of Research at JLL Hong Kong, of course, with their fantastic report about expats returning back to the city.
Okay, you can get an insider's guide to the people in shaking up the finance hub. It's our Hong Kong edition newsletter. Please do sign up. That's a QR code on your screens. There should be something on what we just talked about just now. Coming out here.
Don't ruin the surprise.
No, we'll leave it there. Coming up next.
You'll know in 2 days.
Coming
up next. China's leaders are striking a confident tone on the economy despite signs of a deepening slowdown. We have more on why Beijing is focusing on quality over speed next, which is a bit different from what we're hearing from the street. This is Bloomberg.
Okay, it's time for our trending in China segment, and really this is a look at what's making headlines and what people are talking about in national newspapers, sparking conversation also across social media. China's Communist Party mouthpiece, the People's Daily, has published a series of editorials framing the uneven economic growth this year as high quality and resilient. Min Min Lo, our China correspondent, has more on the nuance here. And Min Min, what is the message we should be taking from reading and going over these editorials?
Yeah, I think it's quite unusual that we got so many editorials back to back on Saturday, Sunday, and Monday, all commenting on the economy. And this is notable given the pretty weak economic data that we got on in July, right? So here you can see this is on the second page of the People's Daily. The headline there says, "What does a 4.7% growth in the first half mean for China?" And the article was really praising this hard-won 4.7% growth, which it says is high quality, is resilient. And here you can see there is some acknowledgement that, yes, the government has been addressing some of the risk factors in the property sector, in the local government debt sector, and that has created a certain contractionary effect, yes. But these short-term costs are exchanged for the long-term stable and sustainable growth. And we are seeing the same sort of tone coming from another day's editorial, right? There's another article just talking about how here the economy is resilient and there's a lot of vitality there. And it urges officials not to get bogged down by these monthly and quarterly data, the ups and downs of it, and to focus on the long-term quality of growth, the quality of tech development, the level of industrial development. So again, I think what we should be taking away from it is that it seems like the Chinese government is willing to tolerate this short-term slowness of the growth there while the economy transitions to the high-tech sector and really reinforces this trend that we see, right, in the K-shaped economy where you have the very short arms when it comes to the tech sector, but everything else, the long legs, the long bottom arm of that K-shape is really quite downbeat at the moment.
And it's interesting, as you say, right? It's unusual to see these many sort of commentaries on state media, and maybe it does downplay the prospect of any sort of stimulus moving forward. But it's kind of different, too. I mean, it's quite a stark contrast to what you're hearing from the state media versus what economists are saying about China now, too.
Yes, just judging from the activity data in July, the loan demand as well, the numbers for car sales, for example, some economists have been downgrading their growth forecast for China in the third quarter, and there are growing calls from economists for more demand-side stimulus. Right here you have Hui Shan from Goldman Sachs saying that stronger demand-side stimulus and fundamental reforms to unleash domestic demand is necessary. Otherwise, a cyclical weakness could become structural. And we have also Larry Hu saying that the expectations, at least from the government rhetoric, suggest that, yes, there might be incremental measures in the second half that might be a little bit stronger, but it's still going to be just enough. The government's not going to do more to try to stimulate the economy. And the article did point out that the government did not rely on this high debt, high deficit route to stimulate the economy, unlike some other countries. So that's not a route they want to go on after they spent so many years tackling local government debt. And here you go, Trivium China as well, saying that companies planning around a domestic consumption rebound need to reset expectations. Exporters competing with Chinese firms in third countries also have to expect competition to sharpen.
Yeah, it's interesting too. I think most of the projections and trimming of forecasts have really been about the third quarter for now, I think, among some of these economists, but we'll see what this means for the rest of the year. So Min Lo, thank you so much for bringing that context for us here, our China correspondent, on the latest on how really state media is portraying this sort of macro picture in China right now. Here's a picture of across markets here right now. Continue to see some pressure when it comes to Seoul. Taipei is joining in on that fray here. The TAIEX is down some 1%. We have plenty more to come. This is Bloomberg. Well, South Korea's cultural exports have become a global phenomenon, from K-pop to TV dramas and movies. And as AI reshapes industries around the world, one company is betting robot idols could become the next evolution of K-pop.
As much as Samsung and SK Hynix have thrust South Korean markets into the spotlight this year, the worldwide popularity of groups like BTS and Blackpink, shows like Squid Game, and beloved romantic dramas have been an economic boon long before the meteoric rise of large language models. Music, films, video games, and other Korean cultural industries generated over $113 billion in revenue last year and more than $15 billion in exports. They employ about 690,000 workers, more than double the combined number at the memory chip giants. South Korea's entertainment sector has grown more experimental and ambitious as competition intensifies. One startup looking to disrupt K-pop's traditional idol system is Galaxy Corporation. It's looking to blend AI characters and life-size robot idols to create content without the limitations of human performers. CEO Choi Young-ho says they are not looking to replace people, but create new IP.
Robots can learn everything at once and immediately perform it for people, whereas it might take a person a month or two to learn the same material. The time savings are enormous, and it all happens simultaneously. Once the training is complete, there's no need to do it again, so we can immediately have a robot trainee debut in New York. It doesn't require the 3, 5, or 10 years of preparation that humans need. That's how AI is changing everything.
Galaxy was founded in 2019 and started as a TV production studio behind the Netflix hit Physical 100. Its current roster includes K-pop superstar G-Dragon, actor Song Kang-ho from the film Parasite, and San Francisco Giants right fielder Lee Jung-woo. Galaxy has now opened a 16,500 square meter robot park in Seoul, where visitors can interact with around 50 different types of robots. Choi plans to open new robot theme parks in other major cities, including Dubai, and run a robot idol tour from next year. Among its partners is Unitree, China's first publicly traded humanoid maker.
Even if the hardware, the robot, is made in China, combining it with software made in Korea and joining forces to go global holds great significance. Above all, I believe these robots will become part of people's lives as new editions are released, including special editions of their favorite celebrities that they can collect.
While Galaxy is showcasing one of the first real-world use cases for these robots, Choi says discussions on global guidelines need to take place.
AI is already part of our lives. What's somewhat disappointing, though, is that we don't yet have global guidelines that match its development. Whether that means global laws, systems to protect against risks, or security frameworks. The same wave is now coming with physical AI, and we must not make the same mistakes again. We need to establish global guidelines to ensure that robots do not harm our lives.
Galaxy is now preparing for what could be the first major overseas listings by a K-pop agency, with the goal to file for an IPO in New York and Seoul by late next year. The company has raised about $150 million so far and is targeting an overseas pre-IPO round this year. Galaxy's planned debut will be a test of whether the next generation of entertainment companies creates next stars or codes them. Soe Kim, Bloomberg News, Seoul.
You look like someone who would really get a lot of utility from the future trend here. You seem to be enjoying that.
No robot is going to replace BTS. This is from my producer. We're both BTS fans. Or Hyunbin, okay? They're going to crash landing to you, maybe, these robots, but not really crash into my heart. So, yeah.
Oh, that's,
you know?
the heart of I mean, some of the K-pop stars anyway don't have a lot of personality, so I think that's perhaps where. See, and
that's an opinion.
Immediately, I heard a reaction.
I hear gasps from the
gallery. Clearly, that was a mind that everyone walked into. That everyone
for someone that's not a K-pop fan.
I did not mean that. No, so I was like saying.
It's not. Yeah.
So we were talking about what's my. Not a K-pop fan, but I like K-dramas a lot, right?
You do. He likes the rom-coms.
I like the rom-coms a lot. And
reality TV shows.
Yes. And we won't get into the details of the reality bit. But, I mean, can they actually give you the same... So what attracts people to watch K-dramas, for example? It's just the drama that comes with it.
The yearning, the romance, you know?
Yeah, the emotion that comes... And it's very counterintuitive that robots could deliver the same...
feelings,
emotions that what was the last one I saw that I really spent a lot Startup was a very good one a few years ago, if you remember that.
I haven't seen that one. No.
Bae Suzy and everyone else. See, there we go. So I am a fan too.
I mean the hip hop robots, to be fair, they've got some moves, okay?
Yeah.
They're better. I feel like they're better than the running ones. They're much more dexterous.
Better form?
And better form and more like elegant in their moves. But yeah.
Fantastic one from Sohee.
I love it.
But my favorite one, though, in Korean general culture is someone, you might know, An Ji-soo is someone that is irreplaceable.
If you don't know, the name's... She's based in Tokyo.
If you know, you know. If you don't, you don't.
She has a show before us, yes. Shout out to Sherry.
Our favorite...
Hope you're having a good holiday.
Favorite Korean.
Markets are doing this.
Yes.
How are we going to go from this to King Boar laminates? I don't know. But the stock's up some 7.5% on the earnings.
209% year on year. Of the company. Some of its peers across the Taiwanese space, as you can see also. Well, going the opposite way. Chung Travel. So this one was very much in focus because I think of the changes to the on the Hang Seng Tech Index, I believe, was the story here. Anyway, Jefferies today cutting the price target for the stock, and we're down about 5% as far as that's concerned. Hang Seng Index, we're going into the latter part of the morning session, last 60 minutes before we hit the lunch break, and it's been very quiet, 0.25% to the downside here.
People keep asking if you can dance. Did you know he can actually moonwalk? We'll show you maybe next time.
Yeah.
This is Bloomberg.